Intel Corporation, stock ticker INTC, is undergoing a significant turnaround led by CEO Pat Gelsinger to reclaim market share. Currently, they are trading over $50 per share, and they've actually had a pretty good year. As you can see here, the one-year chart says plus 98%, year-to-date around 90%. And if you zoom out to 5 years, you can see they actually had quite a long dip ever since 2021, down to the bottom here around $27, $25 per share, and now back up almost double. So it seems like the turnaround that Pat Gelsinger is talking about is actually being executed quite nicely. I also think that Intel actually has a pretty good strategic priority for the coming years. As you can see here, they have initiated a transition from being a PC-centric company to a data-centric one, expanded our product offerings in order to seize new market opportunities, and I really like the way they are executing on this particular strategic priority they have. Intel also recently announced a $3.2 billion grant from the Israeli government for a new 25 billion chip facility it intends to set up in the southern Israel. And as you can see, it is an important part of Intel's effort to foster a more resilient global supply chain, along with the company's ongoing and planned manufacturing investments in Europe and the United States. So they are really trying to execute pretty good on this new strategy they have. As you can see here, they actually also operates 4 sites in Israel already, employs roughly 12,000 people. So it's a pretty big player already in the area. Intel is offering a yield about 1%, and the short interest is pretty low. I think it has come down quite a lot ever since they have revitalized the strategy and tried to gain more market share. And if you jump back into the valuation, you can see it trades at a PE non-GAAP 4 ratio of 53, almost or actually more than double of the sector median of 25. But that's not really the story you want to buy into, because as you saw just before, the strategic priorities are there and they are executing quite nicely on them. Obviously, it doesn't happen overnight. So if you go into the quarter earnings, at least the upcoming, you can see the revision and coming down even more. The annual EPS estimates. You can see here for December 2024, the EPS estimates is 1.91, and the low being 1.45, the high being 2.75. So somewhere in between this, let's just say for an even number around 2, that means a forward PE ratio of around 25 to 26, which is in line with the sector median. So this is actually the story that you would need to buy into if you were to invest in Intel now, at least. So what we're actually going to take a look at in this video is, are it still a viable time to buy into Intel? Is this $50 overvalued, or is there still some value or bargain to be found on Intel at the current price? And that is definitely what I want to go into in this video. So beforehand, let's jump into the dividend stats. You can see here, the dividend yield sits around 1%, as mentioned earlier, 50 cents per share on an annual payout rate, and the payout ratio sits really high at 160%, which is just crazy, but we'll take a look at that later. Dividend growth is 0, and if you go into the dividend history here, you can see they actually cut the dividend quite not too long ago, back in the start of the year, because Intel is actually riddled with debt. But if you jump into some of the financial statements, you can see that revenue-wise, they sit around 52 billion over the last 12 months. Go back a couple of years, you are at 70 billion. So obviously, the revenue has taken quite a hit, which is obviously something that has pushed Intel to found these new strategic priorities and try to reinvent themselves, basically. So if you come down to the bottom line here for net income, you can see it sits negative right now, and we don't need to go too far back to see it's above 20 billion. So again, not that long ago, down from 19 to 8 billion and now negative. So obviously they're investing a lot of money into all the strategy turnaround they are trying to do. But if you jump into the cash flow statements as well, you can see here net income again negative, and coming down here to the cash from operations and the capital expenditures to find out exactly how much free cash flow they're producing. You can see cash from operations sits around 15 billion, not too shabby at all. But if you compare it to the capital expenditures, you can see they have gone up back from 2018, 15 to 16 billion a couple of years ago. Now $25 billion they're using in capital expenditure. So they are expanding the business and really try to regain this market share. Yes, it will hurt in the short term, but again, in the long term, I definitely think that Pat is the right person to have this ship turned around. And I think we are already seeing some of it already, as you can see earlier from the grant given by Israeli government. And there's also something similar happen in Germany at the current time. Something you also always want to take a look at is the total shares out on file. As you can see, it's actually risen quite not too much, but a little bit over the last couple of years. So maybe there's some stock premiums or warrants that has been issued or used up from the executive management or whatever, but still it's gone up a little bit, and that can dilute the EPS, so make it even harder for them to actually hit the target. Before we jump into intrinsic value calculations, I do want to take a closer look at what Wall Street thinks about it, and they have it rated as a whole. As you can see, quite a lot of analysts, 44 to be exactly, over the last 90 days. 8 has it as a strong buy, 4 on the buy side, 26 as a whole, and then you have a few people on the sell side as well. So obviously the analysts also think that Intel is executing quite nicely, and they are waiting a little bit to see how they will come up in the coming quarters and so, but nobody really on the, not a lot of people on the sell side. I think that's a pretty strong sign from Wall Street what they think about the stock. And as you can see here, the price target is actually 40 only, which indicates a 20% downside from the current levels. High being 68 and the low being 17, which is, I think, a bit weird compared that the bottom was around 25. So that they should go below that with almost 30%, I think that's a bit wild. So maybe this hasn't been revised upon the new data and so on, but I think this is a way too low. But let's jump into a stock screen and take a close look at Intel. You can see here the Google Finance function doesn't really import the earnings per share probably, but that's okay because we're not going to use that one anyway. Actually, a lot of these things we aren't really going to use, to be honest. What I mentioned earlier, net debt to EBITDA, the debt is pretty high, but still the net debt to EBITDA ratio is actually okay. It's below the 3x ratio I would like it to be at. I think the return on invested capital, return on equity, I don't really think we can see the fruits of that labor yet. So again, we're just jumping to the margin, so you can see the gross margin 75%, operating margin around 25%. Also, everything here is looking pretty good. Price to sales being just 4 is also pretty crazy. The price to book being 2 also looks pretty good. The payout ratio here, it's pretty high as well, above the 60%. The growth rate, we can't really use that. As you saw earlier, they have cut the dividend. So a lot of these data points that we usually go through when I make these videos, we can't really use them for anything because as you can see, yes, they had steady dividend growth rate before, but then they cut the dividend by 50%. So obviously over the last 10 years, they have a negative dividend growth, but in the future, they'll most likely sit around these 4 to 5%. So again, we can't really use this anything. And if you go down here to the dividend yield theory graphs, as we often use, you can see, yes, we are now way below the average yield, but again, they have cut the dividend, so this isn't even indicative of anything, to be honest. And it's the same if we go into some of our valuation methods. You can see the discounted cash flow model as we often use. As you saw earlier from the cash from operations, they have negative cash flow right now, so you can't really do anything here. As you can see, the trend has been gone down quite a lot, but still, you can't really use this one for anything. Then you have a dividend discount model. But what are you going to do again? Because it's based on the average growth from the dividend payout. So as you can see here, now that we're down to $0.125 per share per quarter, then the dividend growth rate is minus 65. And okay, so what is going to happen in the future here? Are we going to grow? I could obviously just guess something, but again, it's not really any data we have to use on. Then you do have the grants revised valuation. That one works, but again, I've just used 2 as a EPS for the future here. I think this model may be not the best for a company like Intel in the current climate. Then you go into the multiples valuation, which is pretty good. You compare them with peers right now, such as AMD, Qualcomm, Taiwan Semiconductor, Analog Devices, Nvidia, and so on. And I think this one is pretty okay. So the stock price becomes 62 here. I think this one actually one of the better ones right now because a lot of the competition are doing similar things to Intel. There's a lot of focus on AI and so on. So I think this one is actually pretty good. Then you have the PE model. You can't really use that because the PE has been up and down the last couple of years. Same with the price to free cash flow valuation model you have here, actually an intrinsic value being minus $44. Again, then you have the Peter Lynch model. Same as the Graham's revised, I don't think that's really applicable here because you've had the dividend yield being cut. You have the PE ratio being on a forward basis. You're not really not too sure if this executes correctly, and the growth rate also coming from the analyst. So what can we do here, to be honest? I think something we need to do is jump into a summary and then take a close look here and see whether or not it makes any sense at all. But before we do that, thank you so much for watching this video. And if you haven't subscribed to the channel already, please do so for more videos in the future. Now let's jump into the summary. And as you can see here, I have excluded the discounted cash flow and the free cash flow valuation based on the negative free cash flow. The remaining ones together gives an average intrinsic value of $28, with the current price being $50. The average current discount is quite bad. We also want to apply a margin of safety, obviously, and then we start with our standard of 25, and depending on some of the key metrics, we either add or deduct a little bit of margin of safety. Again, a lot of the key metrics are not really applicable here. As you can see here, we do have the growth rate and the payout ratio, but none of these are actually what we want to take a look at right now. This is more based on a company that is more mature or at least have some more steady growth. But again, Intel has just recently decided to cut the dividend and actually grow back some of the margins and the market share. So obviously we can't really use this. So putting these 35% over here, gaining an acceptable buy price of $18 is not really going to happen. So I think what we need to look at here, me personally at least, is these annual EPS estimates, which means the forward PE ratio would be around the 25, which is in line with the sector average. And also the only one here, the multiples valuation, which indicates that the Intel is actually a little bit undervalued still and still has some more runway to do before it reaches the intrinsic value based on the multiples and the comparable companies we do have at least. So in conclusion, Intel is undergoing a significant turnaround led by the CEO, Pat Gelsinger, aiming to reclaim the market share, and I think they're executing quite nicely on it already. I do have a little bit of fear that they are carrying a lot of debt already, but I think when we look at this multiples valuation and the forward PE, the 26 forward PE ratio, I think that appears reasonably valued actually. There are obviously some challenges in a competitive semiconductor landscape and the cyclical nature of the industry. Also, Q4 outlooks could indicate some promising near-term prospect, obviously, but the recent negative growth rates, the stock valuation right now at 50 times earnings and so on, I think that is not something you need to look at right now. I think you need to look at the future at these 25 forward PE ratio and the good potential for improvement based on the multiples as we see here with some of the comparable companies. Even though there's a lot of people on hold here on the analyst, I actually think this makes at the current time Intel a pretty okay investment opportunity for investors, mainly because of the reasons I gave here in the video and also its strong equity brand and the scale of it. So I'm very excited. For me, I'm a personal holder of Intel already, and at these levels I could still imagine myself adding to that position anyway. Thank you so much for watching, and I'll be seeing you in the next video.